Three, two, one. Good afternoon, everybody, from a glorious sunlit autumnal afternoon in London. Absolutely glorious. We have a new Prime Minister, a new day, and gilt yields are down, and everything here is wonderful. We have a packed session for you this afternoon, so much so that we did extend it by 15 minutes. So we are aiming to end at 15:15 UK time, 3:15 UK time, rather than 3 o'clock. Hope you'll be able to postpone your next engagements. We have a report to discuss. Good afternoon, Jan. Glad you joined us. We're starting to panic. We have the OMVIF report on digital assets, which my colleague Julian Jacobs is going to give us a summary of shortly. We then have a distinguished panel, 4 great panelists who are going to argue and debate this, and I will introduce them to you shortly. We have some polling in which you are all encouraged to contribute, and we have some Q&A to which you're also encouraged to contribute. So an awful lot going on in the next 75 minutes or so. So without, and just to let you know, the report itself on digital assets, regulation and infrastructure for an evolving economy is available for download either on the website, either from the site now that you're accessing this on, or via your usual supplier or bookseller. Without further ado, I'm very pleased to welcome my colleague Julian Jacobs from the Digital Monetary Institute, who is going to take us through some of the highlights of the report and introduce the regulatory tracker to you. So over to you, Julian.
Well, thanks very much for the introduction, Phil. So my name is Julian. I'm an economist at OMVIF, and I will be introducing this digital asset report. So this year's subtitle is Regulation and Infrastructure for an Evolving Economy. And this turns out to be a very apt title because these 2 central themes around asset regulation on the one hand and infrastructure are really what this report looks at. And this year, our results draw on both interviews and original analysis of country-level regulatory frameworks and infrastructure. Additionally, we offer analysis of 23 regulatory jurisdictions, and that includes the European Union, the United States, the UK, and China. And in addition to that, we also use and really employ our conversations with key stakeholders, and that includes central banks, digital asset innovators, legal teams, and scholars. And finally, we are, of course, incredibly grateful to have the sponsorship of Binance, Copper, and Bittrex Global. And in particular, we're also very grateful to have the contribution of Binance to this report. Now, to start off with the key findings presentation, it might be helpful to just begin with some general context about where the digital asset world is right now. So what we can see here is a series of phenomena and ideas that I'm sure the audience right now will be very familiar with. And that is this idea that over the past 5 years, there has been remarkable growth in digital assets, and that is in terms of their market cap, the number of products, and their presence in the psyche of people. And chief among available products are cryptocurrencies, stable coins, NFTs, and tokenization in general. And it's in this environment that regulators and innovators alike are assessing key questions about the promises of digital assets on the one hand, and the risks of digital assets on the other. So on the promise side, there are considerable opportunities that involve greater financial inclusion, and in particular, financial access for individuals that may have traditionally been left outside of the banking system. But on the other, there are also efficiency gains and cost reductions that come through the reduced need for intermediaries. Yet there also remain risks, and this includes those relating to financial risk, risks relating to volatility, and also to the illicit economy. And indeed, as we can see in the top right corner of the slide, we have seen a late and recent evaporation of $2 trillion in digital value. And now, amid what some are dubbing a crypto winter, there are very real questions about the financial risks encouraged by certain digital assets and their relative level of security against illicit activity. But despite these risks, both traditional financial institutions and crypto native industry are working to foster greater innovation in the digital asset space. And it's with this context in mind that we can now turn to one of the core developments this report looks at, and that's infrastructure that is necessary to the growth of digital assets. So to start with, our report makes clear that there is a present and palpable need for improved data storage. And there are many different forms that this can take. And one of them includes expanding computing power. And additionally, as more people use digital assets, growing machine learning and AI neural networks in order to optimize storage usage. There's also cloud-based storage as well. And although there are clear security risks that might come to mind, there remains ways of mitigating against those security threats while also using cloud systems to maximize the storage necessary for the data underlying digital assets. But then beyond that, there's also the need for improved digital infrastructure around wallets and identification. Digital identification, for example, is becoming increasingly widely used as a important mechanism to ensure KYC and AML compliance standards. And certainly as these standards tighten, we should expect further growth of this. And with regards to the digital wallet, where we essentially have a software or hardware application that stores private keys and allows users to interact with that blockchain, this could be a key piece of embedding more widespread use of digital assets. And indeed, there are many pilots, often in, it turns out, developing countries that are emerging to help create digital wallets to support financial inclusion for individuals who might not have been in the financial sector to begin with. Yet, with this growth in digital asset applications and the relevant infrastructure necessary for its growth, comes a greater importance to key regulatory questions. And this is now what we turn to. So among several regulatory challenges, our report takes aim at the central problem involved in the categorization of digital assets within existing regulatory frameworks. So for instance, should given digital assets be considered a security? Should they be considered a commodity, or else should they be considered a type of currency? And currently there are clearly divergent answers to this question, even within countries. So for instance, consider the divergences between the SEC and the CFTC in the United States regarding the classification of cryptocurrency as either a security or a commodity. And we can see similar examples of this tension elsewhere, for example, in German tax law, where the relative way that cryptocurrency is taxed highly depends on the way it is used and how long it is held. But in general, our report finds that countries are by and large still continuing to study digital assets, and when in doubt, apply existing regulatory frameworks as best they can. And this is true, for instance, here in the UK. But that being said, not all digital assets are created equally, and while there are growing infrastructure dynamics around cryptocurrencies, stablecoins present fresh challenges. And one key issue is the problem of growing financial risk and leverage, which stablecoins can often encourage. And this is forcing regulators to reckon with key questions over asset-backed requirements on the one hand versus more algorithmic approaches to stablecoins. Right now, however, regulators in general currently do not distinguish between stablecoins and cryptocurrencies. That being said, our report shows that there are indeed growing calls to ensure adequate stabilization and efforts to avert reckless levels of financial risk. And this is, of course, particularly true in the aftermath of the Terra Luna USD algorithmic coin crash. But beyond this, there are regulatory issues that go far outside of just prudential classification issues and taxation. And this, of course, is most notable and made clear in the issues around anti-money laundering and security. So as a first point, the emphasis on anonymity has clearly been a central theme to the ideals of many digital asset innovators. But unfortunately, and this is a point that our report comes to on a number of occasions, this ideal has often come at the cost of security. And most of the individuals that we interviewed, whether it was a regulator or a digital asset company, emphasized the importance of regulation, not only to preserve the growth of digital assets, but also in terms of reputational strength. And the efforts to ensure companies adhere to KYC and AML protocols is getting clearly more effective, but it remains a challenge nonetheless. And one key area, just to give an example of where this challenge persists, is with existing loopholes. So for example, the loophole around decentralized exchanges, or DEX. That's clearly an area where regulators are needing to turn more of their attention. But beyond this, we find calls for financial institutions to help promote greater public awareness about digital assets, their volatility, and the risks associated with them. But given all of this, and given the rapidly changing climate around digital assets, it therefore becomes a key issue for all of us to stay up to date on regulations and developments of how jurisdictions are instituting regulations. And this is where our tracker of digital asset regulation really comes in handy. So what we can see here is a screenshot of the tracker, which you can use on our website to look jurisdiction by jurisdiction for all the countries covered in our report. And by hovering over a country, you can then see the most up-to-date regulation. And this will include classifications about whether they are developing new digital asset regulations, whether they've already implemented regulations, or whether there are no laws in place at all. And we analyze regulations for both cryptocurrencies and for stablecoins. And from there, you can scroll down on the tracker and see excerpts from some of the countries that we look at. So here on the screen, we see Australia, Brazil, and Canada. And I encourage all of us to take a look at the tracker and of course the report generally to get a closer look at exactly how countries are responding to the novel challenges of digital assets. So before I turn it over to Phil, I just want to leave us with an easy way to download the report. So you can use the QR code there to both download the report and to also explore the tracker. So, you know, we hope that all of you will take a look at this report. And with that, I think I'll conclude these key findings and turn it back over to Phil for our panel discussion. So thank you all for listening.
Thank you very much indeed, Julian. It's a wonderful introduction and summarizes some of the principal themes and gives us a lot to talk about. Before I introduce our distinguished panel, can I point out to you that there are facilities for you to lodge questions either to the panel in general or to individuals on the question box on the screen in front of you. Just simply type your question and send it in. We're also have put up some polls for you, so you'll see a tab marked polls. If you click on there are 4 polls, and should there by chance be the odd moment of quiet during our meeting, please feel free to go ahead and click on your responses there, and we shall be bringing the results to you in our closing speeches. Just a little bit of fun to see where we're going. With that, I'm delighted to introduce our panel in strictly alphabetical order. This time we have Jan Seessens, who's head of the Digital Finance Unit in DG FinStab of the European Commission, who's played a leading role in pulling together the MICA regulation, amongst other things. So we'll be hearing about that. We have Oliver Lynch, who is Chief Executive Officer of Bitrex Global, fortunately recently recovered from the severe flu, and he's going to be sharing views with us on the prospects for digital assets. We have Carly Lowry, who's the Chief Legal Officer for Copper & Co. and brings some very unique perspectives on the markets. Last but not least, we have Steve McWhirter, who is Director of Regulatory Policy at Binance, in fact, Global Regulatory Policy. So, and we have Rana Courter, who has joined us as well. Very glad to see you. So I'm going to kick off by putting Jan in the hot seat to say the debate in regulatory circles seems to me to have moved on from a view that digital assets is kind of an interesting curiosity, but not really worthy of too much regulatory attention, to a view that seems split between one camp that thinks that regulation is broadly appropriate to it and can handle it, and with some evolutionary changes will adapt. And those who believe that actually we need a wholesale rethinking both of statute law and indeed of regulation to accommodate it before it overwhelms financial regulators. Now, clearly, MICA is a monumental effort at pulling together a codified set of regulations and thinking about this. Where do you stand? Do you think the regulators are on top of this broadly, or do you think there's catching up to do, and if so, where?
Well, I think these markets are moving so fast that I think nobody can claim to be fully on top of all the developments. But I think what is important, of course, also from the broader, say, financial stability perspective, is indeed to be on top of the key developments and also the major flows and the major trends in this market. And for that, from our perspective, it is very clear that indeed the crypto assets, digital assets market needs to be subject to full regulation and supervision. I think that is a broad global consensus as well. You have probably all seen the recent recommendations from the Financial Stability Board, which go very much in that direction, and which also stress indeed, and that's also very much our view, that the key principles of financial market regulation should indeed also apply in the digital assets space. Now, another matter is then when you look and examine the actual rules and regulations which are in place, and that's something which also needs to be done a bit jurisdiction by jurisdiction. Do they ensure this? Do they actually make sure that the principles also that all actors are covered and that the key principles are indeed also, let's say, in place? And I think there, on the European side, we did find that the existing rules were not always sufficient. I have the impression that this is now more and more also the conclusion indeed in some other jurisdictions. The US, I think, is debating regulatory change, and I think key regulators have come out with indeed also statements considering that on some areas, like for example, stable coins, clearly added legislation is necessary. Voila. So I think one needs to look at this question also a bit jurisdiction by jurisdiction. I think what is a bit dangerous from our side or not sufficient is just to kind of limit yourself to the principle, same activity, same risk, same rules, and then think, well, then the rest of the supervisors just need to deal with it. But I mean, I think the supervisors are telling us, and I hear the same in other jurisdictions, that in some areas they have powers, in others they don't, or they maybe don't have enough powers for these things to grow very big. So that is something which also the regulator is the responsibility of the regulator to make sure indeed that we can also apply these general principles in practice actually in this space.
Philip, I think you're muted.
Indeed, thank you very much indeed. So let me start again. Just a couple of quick follow-up questions, Jan, if I may. Julian mentioned the question of terminology. I mean, in the view of the Commission, are cryptocurrencies payment instruments, securities, or commodities? And my second question alongside that is that, again, the report talks about applications of NFTs, non-fungible tokens, to things that are not strictly financial services, i.e. Works of art, fan tokens, whole range of applications which traditionally do not sit within financial services. How will the European regulatory environment adapt to supervise that, if at all?
Yeah, so the terminology question is an interesting one, but in the end, what we decided is actually that given that we would need indeed some dedicated rules, because I mean, a certain part of the space is not covered by the existing rules for financial instruments and others, we decided that we will not indeed, let's say, look at primarily at indeed the purpose and the objective of certain instruments, because we realized that well, different people use crypto for different purposes actually in the end. So in a way, if you regulate by purpose, whether something has more investment purpose or more a payment purpose or some things, you may actually, well, you may create really hard challenges. So in the end, actually, we decided not to go down this road, indeed, and create this new category of crypto assets. Of course, within this, I mean, some instruments are more suited for payment purposes than others. And actually, in our view, really for solid payment systems, they can only be built indeed on stable coins, which are not, let's say, just crypto assets, but which are backed indeed by a reserve of actually fiat denominated instruments. And so we have introduced specific, also rather conservative rules for these stable coins to make sure indeed that they are indeed stable and that we do not see anymore what has happened earlier this year. And I think that there is quite a bit of work to do in this market. I think probably all the products in the market need to kind of change and adapt to indeed provide the stability and transparency which the market would need. Now, on non-financial, non-fungible tokens, which you mentioned, indeed, a token on a piece of art, but also the CryptoKitties or the Bored Apes #1 to 9,900, which you can also buy on the internet. It is a difficult area. From our perspective, let's say from the Commission's perspective, I think we do think that there is a need for also supervisory monitoring in this market. If you look at some of these markets, I think it is really textbook market manipulation which is going on there. And really, I mean, you see why we, if anybody has forgotten maybe why we need financial markets and securities market regulation. In these markets, you can see it every day, basically. But of course, indeed, the function of those instruments is not always financial. So I think ultimately the regulation which we have now in Europe goes a bit in steps on this. We have for the time being carved out those tokens which are truly non-fungible. That's a test which the supervisor needs to do. If you are really unique, as opposed to be indeed part of a larger series or collection, for example. So, but if you're truly non-fungible, indeed a token on a single piece of art, I think then you are not covered by our rules. And then we will indeed, in a second step, examine, let's say, what is an appropriate framework for these truly non-fungible token markets in a way.
Do you anticipate that they will move within the jurisdiction of financial regulators, or that you will create a separate institution, or?
I don't know, and I think this is really too early to judge. This is exactly the question which you can have. I mean, they are not really financial in nature in some instances. On the other hand, I mean, as I mentioned, all the reasons why we supervise financial markets partly in a way, and I mentioned market manipulation, but I mean, the money laundering part, you can mention equally, are really also quite present there. So indeed, you can either decide that you want to have an ad hoc, let's say, monitoring of these markets is a dedicated one. Question is then, well, who would do that? Or you can decide that you, in a way, do a proportionate application of financial markets regulation. I don't know what is the right answer. This is a very difficult one.
Which is why I asked it. Maybe, thank you for that. Maybe I can pass to Oliver Lynch, who has two distinctions here. One is he's chief executive of a leading player, Bittrex Global, in these markets, but he also has a background as a lawyer, so he may have two views. So can I kick off just by asking Oliver, Do you think the regulators in the major markets in which you operate have got a handle on this, or are there major gaps? You know, for example, in the United States, they can't even make up their minds apparently on which institution is going to regulate what. So, how does one operate as a firm in that kind of environment?
Sure. Well, thank you, and thank you first of all for having me on the panel. I will stay clear of the United States, actually, if I may, because Fitch Global exists as a rest of world offering, kind of for exactly that purpose, which is that the US regulatory regime is unclear, uncertain, and we as a company don't want to subject the rest of world users to the US regime. So let's look at what the rest of the world are doing. There are some regulators that have really got to grips with it and have really, at a very early stage, identified the new technology, identified the new opportunities, and are taking a crypto-first approach to it. So BitGEX Global is regulated in Liechtenstein and it's regulated in Bermuda. And those are two countries that from a very early stage identified crypto as something that they wanted within their economies and said, right, how do we do this properly? And the advantage of them being small is once that political decision has been taken, there was then a very rapid sort of series of actions that took place to establish the regulatory environment. But it's not just enough, and this is what Jan was saying, it's not just enough of having words on a page. Those words need to be enforced. And the other advantage of having being regulated in Liechtenstein and Bermuda is what you have there is very experienced, very knowledgeable, very clever regulators already used to regulating financial services more broadly. In Liechtenstein, that's predominantly private banking and wealth management. In Bermuda, that's insurance. But that means you have regulators that know what they're doing and can actually engage with the technology and get to grips with it. And what we're seeing more and more is that kind of what I like to call crypto-first approach to regulation being successful. The most successful attempts that we have seen have avoided or eschewed the argument of that is this a derivative, is this a security, and said, no, it's crypto. It's its own thing. And we're not going to try and shoehorn this new product suite into existing frameworks just because it's convenient. And like, I understand the desire there because you've built up this framework over many years. But so it might seem more straightforward just to apply those rules and see if you can fit a round peg in a square hole, but it doesn't work. It doesn't work as effectively as actually using the principles. And again, this is what Jan was saying, using the principles that we've learned over the past 30 years and applying them to new asset class. So our regulators on top of it, increasingly, yes. And we at BitGEX Global have been pushing for years to actually engage with a regulatory regime. So you can say, when I stand up and I say I'm regulated, people know what that means. There's content behind that, in a way that they don't need to be global standards, but they need to be a global understanding of what regulation means. And so the most effective regulators, and they are getting to grips with it, are taking that approach and are looking at, and this is why the tracker that you guys have produced today is so good, because it allows you to see which jurisdictions are taking crypto seriously. So when someone stands up and says, I'm regulated, we, journalists, the community, whatever we want to call it, can ask three really important questions, which is, where are you regulated? How are you regulated? And how does that make markets safer?
Let me ask you, some statistics published last week, the 3 jurisdictions that have turned down or refused the most authorizations for crypto firms, digital asset firms, are Hong Kong, United Kingdom, and Singapore, in that order. Now, does that say that those jurisdictions know something that we don't? Are they inherently economically more conservative and therefore don't wish to see what might explain that? Because we are seeing some very different regulatory approaches emerging around the world, and arguably the center of the global digital industry, the United States, if I may be so bold, hasn't really got its regulation sorted out at all yet.
So I think it's important not to judge jurisdictions too quickly on how they're handling what is still a very small number of applications in general. The fact is, there are very few exchanges at all and very few market participants at all that are trying to get regulated in any meaningful way. So when N is so small, trying to make judgments on what that means about the country's approach to crypto more generally can be quite dangerous. What you can see, though, is other signalers can be quite important. So the UK, on the one hand, when Mr. Sunak was Chancellor of the Exchequer, says that he wants the UK to be a hub for crypto. On the other hand, still has a ban on derivatives, crypto derivatives. And you think, well, there's a disconnect there. And the only way you can explain a disconnect is they haven't yet figured out what their genuine approach is. So look, we're used now in financial services to working at an incredibly rapid pace. And one month in crypto is about a decade in normal time. But the fact is, it's still an incredibly new technology. Countries are still figuring out what they want to do with it. And so initiatives like MiCA, which really drive the conversation forward, but beforehand, the CBTG in Liechtenstein, DABA in Bermuda are, we think, showing a really good model for those countries that want to get involved, but want to do so in a safe and secure way. So yeah, there are mixed signals coming out, and there are so many reasons for it. It may be a small number of applications, that there may have been problems with those applications. It may be that the regulators aren't aligned with the legislators or the central banks on what they want to achieve and how they want to achieve it. And it may just be inherent uncertainty as to how to go about things. And yeah, trackers like today's, like your report, really shine a light on that, and hopefully give confidence to those regulators and those legislators that are sitting there saying, we want a piece of this action. We think there's something important going on with crypto, and we want it to be part of our macroeconomic infrastructure. How do we do that? They should go to your report and get some good ideas.
Oh, thank you very much for the enthusiastic support of the report, and thank you for contributing to it. So a lot of your wise words are in there as well. We did last week have a very good discussion with the UK Law Commission, which is looking at this, and one of the things they're talking about is a new class of property rights. It has been suggested, and I'm directing this at Carly, who also has a background in both crypto and the law, that the jurisdictions with Anglo-Saxon common law may well eventually prosper in regulation because the common law allows them to adapt dynamically to changes, whereas changes for Napoleonic Code or statute law is rather more abrupt and difficult. Do you think this means we're going to end up with a sort of tapestry of jurisdictions in terms of regulation? And does it matter, or should we be moving towards standardization?
So standardization is incredibly helpful. It is incredibly efficient. But I think there are so many areas where actually having that tapestry, as you described it, Philip, it makes it a little bit more interesting for market participants. As Oliver was talking about, Bittrex placing themselves in jurisdictions where they found regulators that shared views that they held as a company, it kind of creates this like competitive field for companies to go to jurisdictions in 4 different countries that are looking to bring business into their jurisdiction to advance the ball a little bit faster. Now, in the UK, I happen to think we've taken an interesting and a little bit of a wait and see, but a very sensible approach. I should also clarify, I know I sound American. I do sit in London. I've been here for 12 years. So just in case anyone listening was wondering why I sounded like I was in New York, I'm actually in London. We saw just yesterday, the UK, the House of Commons passing legislation to start to bring crypto into the ambit of the Financial Services Markets Bill. I think one of the challenges that we're seeing is a little bit of conflation between the activity, which is regulated, and the assets, which present novel questions around the law. And this is something that, Philip, you mentioned the law commissions work, and they've been doing an incredible amount of work around, potentially introducing a 3rd category of property. And I won't bore everyone to death with the long-standing history of UK jurisprudence on property rights. However, this really would be groundbreaking in the UK to see us plowing forward to define a 3rd category of data property, a data object, which is quite different from the other types of objects. If we can establish that either through something like the Law Commission or in common law, we will have an advantage, we being the UK and other common law jurisdictions, because you will see legal certainty around who owns what, which is a real challenge for digital assets. Unlike property that you can physically hold, unlike a contractual right, which people can read, a digital asset and its ownership really introduces some unique questions that I do think that countries where we can progress a little bit more quickly through the courts might very well be uniquely positioned to get a bit of advantage in.
So you operate, like Oliver and indeed Stephen, Copper operates globally markets. Are you looking for regulators to apply a one-size-fits-all? Do you think there should be categories of minimum standards and then variation around the theme? What would make life easiest for you? Because I assume as responsible players, you wouldn't reply, well, we'll have a free-for-all with no regulations. Thank you very much.
No, absolutely not. And I mean, just, very candidly and very genuinely, it's not about what's easiest for us. It's about financial stability. It's about fairness in the markets. It's about consumer protection. I mean, those are the purposes for which regulation exists. And so while I would love to just be able to fill out one form, have my license and run around the world on my merry way, I think that that's probably not quite the right motivation for regulation.
I think that's a hugely important point. Sorry to jump in there, Carly, because I think what you are seeing, a bigger divergence, is actually not between regulators trying their best and coming up with different approaches, but regulators that are trying and regulators that are almost promoting or allowing companies to use the cloak of regulation, the language of regulation, as a boondoggle, as a trophy to put in the trophy cabinet, whilst actually not providing any kind of security for their users at all. So what we must be really wary of nowadays, everyone says, oh yes, so crypto should be regulated, and they look very serious when they're saying it. Actually looking behind that and saying, well, what does that mean, is the most important thing. So regulation shouldn't be a binary view. It's not that you're either regulated or that you're not regulated. It's that you're regulated in a meaningful way. And it's hard. Right, it's really annoying. It's terrible. I have to spend lots of time and money and effort and turn away lots of business. It's difficult, like being regulated, and it should be difficult because ultimately people are relying on that badge to say, these regulators, these authorities have looked at what they're doing and how they're doing it, and have confirmed that they're complying with a certain standard. That means that I can play with confidence. It should be hard. It's really annoying, but without that, it's not worth the bit of paper that it's not even written on.
I'm going to just refer to Carly again, just a question specifically for you, Carly, from a lady by the name of Noah McGuire, saying, is the use case for intellectual property management NFTs, so I presume that's copyright, patents, etc., more likely to emerge in crypto-first areas or in hubs of legal innovation?
Gosh, what a question.
Yes, I give it to you.
Well, thanks, Philip. I'm gonna say the latter. I'm gonna say hubs of innovation. So I'm thinking about things like secondary markets for ticket sales, right? So, you're an artist and you have a concert and you would rather the proceeds of those ticket sales come to you. This has nothing to do with kind of being crypto first. This is just about protection of royalties and property rights in that way. If those tickets were NFTs, you could ensure that that the sales and the proceeds of the sales are actually going to the artist, as opposed to a scalper who buys up 100 of them and then sells them on the black market. I don't know if that really answers the question, but you gave me a bit.
Well, it is one of the interesting new applications, I think, of NFTs. Just the ability to be immutable, to have absolute provenance, and to have smart contract capabilities built into them, do make them enormously convenient for things like property rights and indeed the applications.
Well, and for artists and creators of any type of intellectual property, right?
Yes. So Stephen's been sitting there very, very patiently. Stephen Berta, who is Director of Global Policy at Binance, and also has the advantage of having once been a regulator with, indeed a supervisor with our very own FCA here in London. So number of questions are asking, don't we have a risk that a lot of digital asset work is about innovation, it's about creating challenges to traditional finance and the traditional structures, and aren't the regulators just simply trying to crush it all and get back to boring old trad fin? Could you use that as an intro to your comments?
Yeah, I mean, and just to kind of link it to the conversation already, I mean, it's a big world out there, as we've already identified, and crypto is incredibly complex, as we've already identified. So, you know, with both hats on, Philip, ex-regulator, currently working in the industry, you know, I have a degree of sympathy here. It's been very fast growing. You know, there's new technology that's been introduced. There's lots of new business models, products, etc., that have been introduced into the kind of industry. So untangling that and trying to work out exactly what that means as a regulator, what that means for the industry, incredibly hard. And I think it will take time. But as Jan touched upon in the context of MiCA, that was introduced to bring some certainty to the market, trying to help people understand what regulators expect. Likewise, the FSB, you know, they've introduced recommendations the last couple of weeks. Again, I would say with a view to trying to introduce a level of consistency globally, to help regulators and industry both understand perhaps what's expected of them as I suppose the market matures. Everybody tries to unpack a little bit more what crypto means in the broadest sense. You've already touched on categorization, you know, is it or is it not, etc., etc. And there's plenty of ongoing legal debate in that space, so I won't bore anyone. But equally, it's a big, big area that may or may not involve financial services. So I think there is a need for regulators. And again, you know, are they moving fast enough? They've all got different levels of regulatory maturity. They've all got different levels of knowledge and experiences when it comes to this industry. They've all got different objectives, different priorities. You know, there's different politics in different countries. So it's a very, very complex picture. I don't get the impression that regulators are trying to crush it. You know, they're not looking to, you know, vote for a certain team, so to speak. You know, they exist really to achieve certain objectives that have been determined by them, usually by their governments, their parliaments. So they have to look at crypto through that lens. You know, is it consumer protection? Is it financial stability? Is it financial crime, etc., etc.? There's been different priorities that we've seen globally. I think financial crime in particular, prudential is very relevant at the moment. But as it matures, as I say, and as people understand it better, regulators will start to introduce what they think is appropriate. And hopefully, to kind of Oliver's point, that once they've got that level of knowledge and confidence, the outcomes are consistent with their objectives and they're proportionate as opposed to the risks that the industry presents.
I mean, given that this is a global industry and with components of it as well, scattered in different countries. So I could be running a company that's headquartered in Liechtenstein with its servers in Kazakhstan and its customers in the United States, running software developed in South Africa. So because of that, our report very clearly highlights that regulators around the world are in absolute stride agreement on, yes, there should be harmonization of regulation. And then when you go a bit further and say, okay, so what therefore are the very minimum requirements on which we should harmonize? The answer is always, well, the ones I have. And I just wonder, how do we balance that yin and yang between the desire for national sovereignty and national control and the the need to protect one's own citizens versus one's international obligations and the need for this to have some kind of international regulatory harmony.
Sure. I mean, there are global standard setting bodies. They've got their remits, whether it's banking, whether it's securities, payments, etc. So that is their primary focus. In the same way, FATF's primary focus is much devoted to financial crime. So there is a level of consistency that's been attempted. But as you drill down, as I say, various different regulators, they've got different aims and objectives within their domestic markets. And you've also got politics that are introduced in those markets as well. So although you will get some consistency, I've been in regulation long enough to realise that it's never perfect and you will always get nuances in the different markets you operate in. What you hope for is some certainty and clarity as to what those rules are, so that it helps you comply in that market, but equally it helps the regulators to achieve the objectives that they're supposed to be focused on.
Just a very quick specific question for Stephen and for you, Oliver, from Anonymous. What's one of the regulatory problems about the digital assets industry and the crypto industry, which is that a lot of it is dedicated to keeping its users anonymous. This actually is a question pertains to that, which is, Oliver and Stephen, how do you ensure integration of trading and custody does not affect customers' beneficial ownerships of their tokens? And this question says, e.g. in insolvency. I would broaden it to say more generally, given that you probably don't know what the beneficial ownership is to start with. Stephen, could you pick that up and then I'll pass that one on to Oliver?
I'm going to give it to Oliver, given his kind of role and background. I thought he might want to jump on that one.
All right, Oliver, the ball's been passed to you.
That's very kind, Stephen. I appreciate it. And yeah, I mean, my background is as a regulatory lawyer for over a decade doing this in the traditional markets. So these are not new questions, but the answer to the direct question from Anonymous, great friend of the show, is it comes down to individual countries defining what they mean when they say that there are property rights associated with a token. So what is a token? What does it mean when I say I own it? What does it mean when I say I transfer it to you? How do you know that I've transferred it to you? And how does Carly and how does Stephen know that I transferred it to you? And the blockchain actually provides phenomenal opportunities for clarity in a way that actually traditional assets don't. When we spend a lot of our time and effort as lawyers talking about things like perfection of security, talking about the need for CCPs when we're doing transactions on traditional exchanges, actually fully embraced, all of that goes away with the blockchain. It should be much easier to say what it means when I say I transfer you, one BTC, but it does rely on an understanding of the property rights associated with that, and it does rely on the individual jurisdictions and ultimately their conflicts of laws as to how they interact with each other, coming to a consensus on what that looks like and what the shape of that is. So it comes back to actually your last question, which is how much harmonization do you need at a global level, right? Because you can't, in a modern financial world, develop these things purely in isolation. There has to be some kind of shared understanding of what's going on here and what the rights behind these assets are. So just as if I want to operate a traditional exchange, I look to the rules of my national jurisdiction to understand how I run that. But I know that things like CPS and IOSCO set minimum standards for financial market infrastructure, and global understandings of conflicts of laws and property rights set out what it means when I buy something on an exchange, or when that trade is cleared through a CCP. That needs to be developed from crypto, and it is being developed, but it's not there across the board in a comprehensive way. And again, it comes back to that's what we were looking for when we were looking to see where we should be regulated, because Liechtenstein and the CBTG did come up with answers to that, did change their fundamental private law, their contract law, their tort law, their property law to reflect what it means when I say I transfer an asset to you. So on insolvency, these things are, as always, where the rubber hits the road, right? Because it's where it really comes to test. But there's no point in trading, fundamentally no point in trading, if at the end of the day, you don't know that you've actually bought or sold something. So it's not just an insolvency, it's the whole life cycle of a trade.
I know you've done a lot of work in this area, so I was going to shuffle the ball onto you as well, please.
Sorry to jump in excitedly as the lawyer thinking about things like property rights again. But Oliver, I know that you use the word transfer with respect to one's crypto quite a bit. And I think that is like it's an action, but it's quite a nebulous action, and it can mean all sorts of different things. And I think when we look at the evolution of regulation in this market, it's important to consider that the actions that people have been taking with crypto are only increasing in their complexity and sophistication. And so it is natural that the regulation and the legal status around it is only now starting to increase. It is an industry that has largely started from the retail side, which is quite unique. And the activities of retail actors tend to be less complex and less sophisticated. And so if I transfer as a retail participant on a retail exchange, my crypto from my private wallet onto the exchange, it's a relatively straightforward transfer. It doesn't really answer the question, if that exchange goes insolvent, who owns what? That is a next layer that has to be dug into, but it's a next layer that doesn't have to be defined in regulation or in law. It can be defined in contract between the parties, right? So, I signed up to terms of service. Now I may or may not have just clicked through and read what it said, or maybe I didn't. Now that we're seeing institutional adoption and you're seeing a lot more complex activity, we're really getting the chance to grapple with these kinds of questions, because when an institution transfers a huge chunk of digital assets to a custodian, they're not just going to leave it there. They don't want to just have it sit there. There's this efficiency and utilization of those assets and the asset servicing that comes with it that starts to see a little bit more activity around the edges of that transfer. And that's, I think, where we're going to start to see real development. And we are seeing every single day around the questions that Anonymous has very, very sensibly alighted upon.
Yeah, you've heard this discussion from an EU Commission perspective. How concerned would you be about regulatory arbitrage between jurisdictions? Let's say the EU has MiCA and one set of regulations and somebody else has different ones. What's the balance between global standardization on the one hand and what I call a tapestry of jurisdictions on the other, which some people may call regulatory arbitrage?
Yeah, indeed. Some may call it regulatory arbitrage, but also on the other side, of course, it is also regularly duplication and let's say chaos for operators, actually. So in that sense, I think nobody has an interest in this. I think within the EU, this was precisely why we decided, okay, we'll have one single regulation for all 27 member states. We're not going to leave this, the mushrooms were spreading, and that's fair, that's good, but we're not going to leave this to 27 different regimes. We have one set of rules, basically, so I think that's already a good step against these tendencies. I think globally, what is essential is that there is indeed agreement among regulators on the principles underpinning this. I mean, we will not be able, and I think we've never been able to agree line by line and word by word on the same rules. But I think the key, let's say, also regulatory drivers, the key costs, the key business models, the key principles need to be, there need to be common views on this. And I'm personally not unoptimistic on this. I think the FSB work is a good first step on this, which sets out really the key direction of travel. So I am halfly optimistic that there can be indeed a global consensus also, at least among, let's say, a number of countries indeed on the direction of travel. But I do think it is essential, because what we all see is, of course, the enforcement arms of supervisors. You can stretch them, you can kind of give them additional powers, but at some point, I mean, you are just responsible for your own jurisdiction, and these businesses are, of course, inherently cross-border. So there is a limit. That's why I think, yes, supervisors need to be proactive. They need to not to be shy, also maybe to shut down a website which comes from a third country, basically, if it is not authorized. But at some point, basically, there is a need for a minimum level of global kind of a standard in this area.
Philip, can I?
Yes, by all means, sir.
On the question of a global standard, I'm going to throw out there a point that I think has been touched on, but we haven't dug into too much, which is around digital identity and whether that's an area where if there could be more of a global consensus and standardization, it would really advance a lot of the other objectives, in particular that of financial inclusion. I'm thinking about, folks who are at global exchanges, like a few on our panel, who may have customers across the globe whose KYC documentation and their data points simply will not fit into a 5MLD type of a regime with the best will in the world for reasons that are just unique to those countries. And so you see countries with really high crypto adoption that very well could be integrated into the wider financial system, but for that KYC hurdle, where you have standards developed in one part of the world that don't account for data points in others. And I just wonder whether anyone thinks that's one area, leaving aside all of the things that will terrify my privacy professional colleagues and friends around adoption of a global digital identity, because indeed there are some very terrifying things there if we get it wrong, whether that might be one area that we could focus on and try to advance the ball for those reasons.
Well, certainly my colleague David Birch, who sits on our Digital Monetary Institute Advisory Board, has written a couple of books on digital identity and is a very strong advocate for the view that the digital economy can never really happen until and unless we find a way of resolving precisely that, but giving everybody a unique digital identifier. As you say, that paradoxically, that raises some fascinating libertarian questions, which are at very odds with Nakamoto and the whole founding philosophy, if you like, of the blockchain.
Well, I mean, yes and no, Philip. I mean, we're not talking about anonymity. We could be talking about pseudonymity here. And I think that, parsing those two and treating them quite differently might be a way to open up these doors in a way that doesn't offend these founding principles that Satoshi very kindly embedded in that Genesis block.
But pseudonymity means somebody somewhere has got to have the key to the pseudonym.
Correct.
And when one looks at some of the discussions we have, for example, our research around CBDCs, there are a number of countries where citizens are massively opposed to central bank digital currencies because they don't want the central bank holding personal data.
But I think it's a scale, right? Because it's easy for us, and I say us meaning the five of us on the panel sitting here in, I think we're all in Europe, to take a very European, I should not say the EU, the very European approach to what identity looks like. We're all perfectly used to having a passport as a primary means of identification. That is simply not the case in huge swathes of the world, including the US, for example. So, okay, 5MLD says onboarding requires passport standards, and therefore basically says most of India, most of the Far East, most of the US, you are not welcome. And that's fine if you're taking a very European-centric view of what the world looks like. But I think Carly's point is those areas that could most benefit from crypto are underbanked or unbanked jurisdiction, or people where there are large numbers of underbanked or unbanked people who simply don't have access to the traditional finance. Right? They can't get regular banks to provide financial services or products to them. Crypto could provide them with access to a whole range of things that could frankly make their lives significantly better. But those of us that want to do crypto properly in a regulated way are prohibited from providing them with those services because we're complying with standards that by definition exclude them. So look, I think Carly's designing a future utopia where we can resolve that problem. I think we're probably some way away from that being a workable solution, unless there are real strides forwards in the technology underpinning what it means at a pseudo anonymization sort of type of thing. I think there's quite a lot to bridge that gap between everyone must have a passport and what's a passport. We just need the digital identity. So maybe we'll get there one day.
Well,
I mean,
go
Sorry,
on,
go
Darren.
ahead.
It's your point.
I was
It's
just
a
going to say, I just struggle with the idea that folks are uncomfortable giving their data to the government, but they'll give it to Mark Zuckerberg. Like, I mean, don't we need to sit down and have a little talk with ourselves about who we're giving our data to, how and when? Your data is being collected, whether we know it or not, in so many ways. I think that there's a real raising of consciousness that needs to happen to advance the dialogue just beyond, I don't want to give it to the government. I mean,
you've been based in the UK, as you say, for 12 years now, and you will know just how incendiary the question of ID cards in the United Kingdom is. And yet, you carry a driving license if you drive with a picture and everything else on it. But there's every time you do polling in the UK on this, it comes back to say, absolutely not. We're not having,
Well, but Philip, that's exactly the point, which is I think people are much happier giving their data if they're getting something in return. So they are happier.
I give more trust to giving my data to Andrew Bailey than I do to Mark Zuckerberg.
Well, maybe, but I think actually people are generally happier giving their data, and we've strayed way off topic, but I love it. Happier giving their data up if they're getting something in return, right? And so if that's access to a Facebook account, then that's something they're getting in return. If that's the ability to drive on a road, that's something in return. And we're in Europe here. I'm sitting here in Zurich, but I live in Liechtenstein. We do carry around ID cards with us every day, and we're required to by law, which is, as you say, anathema to the British mindset. But when you're getting something in return, people are generally happy at giving up their data. So what if the thing you're getting in return is access to all of those financial products and all of those opportunities that crypto affords? How do you make that case to people? And maybe you'll get a lot more adoption than you're seeing when it's just a mandatory hand over your info to the government because we said so.
I think it's a problem that's existed for a number of years. Fintech companies generally have struggled, because of the digital identity challenges. But I do think innovation does provide some solutions, and I think it's more just a matter of time. I mean, if you just think about this industry, you've got your blockchain, your tokenization, your cryptography. But if you think about ways of gathering people's identity, concepts like self-sovereign identity, where you pull it from various different sources to corroborate that person's identity, you then use other forms of technology like privacy enhancing technology to kind of mask it, so you verify who the person is, but you don't give away their identity. Add that back onto the blockchain in the context of something like an NFT or a soul-bound token, which is unique to the individual and can't be transferred. And you start to see some solutions that very much look like a digital identity that people can utilize as long as they've got access to the internet. I think that's the reality.
Or indeed smartphones, which I presume you see is the same thing. Because, again, we look at in other office work at the applications of blockchain technology and tokenized exchange in countries without banking systems that are as developed as they are in Europe, where there is some tremendous potential. And can I throw to the fore of the question? We're hearing a lot about the metaverse. One philosopher recently saying the metaverse is a singularity point in time which will change everybody's existences. We talk about it a bit in the report, quite interestingly. Do you see this as the Web 3.0 where we're all heading, or is it just a massive distraction? Let's start with you, Stephen, because you're in pole position.
I would describe it as a concept and as a part. I wouldn't describe it as Web 3. I would say it's a subset of that, Philip. And what will it look like? Who really knows? Will people use it? Who knows? There's huge challenges in the context of the metaverse when it comes to regulation. So we've still got all that to work through. You know, we're just talking about digital identity, age verification, what country you're in, what activities you're taking part in when you're in the metaverse. Are they regulated? Are they age appropriate? Are they illegal? You know, what happens to your data? Where does that go? I mean, it's a huge piece of work for very, very many regulators as well, not just financial ones, but you could be looking at gambling regulators, you could be looking at data protection regulators, competition regulators. So it's a huge subject in itself, but I wouldn't describe it as Web3. I think I would describe it more as a subset.
That's just my poor terminology, but arguably NFTs are going to be both the commodities and the currencies that are operating within these virtual worlds.
I suspect so. I mean, it's conceivable that, you know, people will have their digital items in these virtual worlds, and you'll be able to, you know, interchange in and out of different virtual worlds and potentially take those with you. So yeah, NFTs, based on what they're intended to achieve, will form part of that kind of metaverse. But there could be so many other products and services that exist within the metaverse that are either, you know, defined by regulation, defined by the technology, or defined by the businesses that actually produce the environment. So yeah, this is a whole nother world that we need to dive into one day.
And Jan, are you and your team diving into this world at the moment, or have you got enough on your plates with?
No, absolutely. We are diving into everything. The question is how deep we can dive, basically, sometimes. But I think, honestly, I mean, from the let's say, I think from the financial supervisory and the regulatory perspective, I think we also need to wait a bit more until this all development all consolidates in a way. So I agree with Stephen about the host of issues which it raises, and I think the Commission will also later on, I think next year, will announce an approach indeed to the metaverse, highlighting some of the challenges which are there, and I think some of the stuff, for example, around market structure, I think is something which probably one needs to look at early on. I think, I mean, the experience from MiCA is a bit, at least in my view, that if you want to really put, let's say, also, I mean, approach things from the financial supervisory perspective, there needs to be a certain kind of, I mean, experience in the market already. Otherwise, you will just kind of, I mean, you are regulating into the dark, and you may do something which is completely useless or completely harmful. Or so in that sense, I think at this stage on the metaverse, I think the ball is firmly in the camp of the market to see, let's say, how this will, what this will actually be, and how this will develop. We're watching it very closely, I can reassure you. And if need be, we can also, of course, intervene. But let's say, I would say, if we get a good framework for indeed crypto assets, possibly also for NFTs, and if we have a good digital identity framework, Carly mentioned it, I fully agree, but I also agree with the challenges it poses. We're trying now in Europe to have indeed in the EU a European digital identity for 27 member states, and that's already complicated enough. But I mean, if we get those things in order, I think those are also essential, let's say, for the metaverse. The last one I would want to mention is indeed, or let's say also the regulation of platforms and of gatekeeper platforms. Again, I think a key topic also for the metaverse, and we are trying to put the framework in place. Data protection is another one. So really, I think, I mean, we are putting many of the kind of the planks already in place for the broader market structure, and within that, yeah, I think we need to see a bit more what this will actually be and how this will actually develop.
And are your principal policy guidelines essentially around, are they focused primarily around encouragement of economic growth and innovation? Is it around consumer protection? Is it around economic and financial stability? Or would you say, well, actually, we try and balance the three?
We're trying to balance. I would add indeed also competition policy concerns, indeed, which I think are quite relevant in these markets. So yes, absolutely, we are balancing these things. I think, I mean, in the EU, and again, I think I can report there a bit also of the experience with the MiCA negotiations. As anywhere, you have the whole spectrum of people who think that basically this should all be banned, up to this is going to save the world. So I think what you need to do, of course, if you put in place a public policy framework, you need to somehow find a middle ground in a way. And I think with MiCA in the end, we managed to do that. I think it was supported by all member states, and I think 80% of the members of the European Parliament. So yeah, that sometimes the price is that you are somewhere ending up somewhere in the middle. You cannot be at the very front or at the very back. But on the other hand, I think that's probably the way forward.
Oliver, metaverse, hype or new world?
I think the jury is still out. I think, when you talk about crypto being new technology, the joy of that is that every time I have the conversation with those of my colleagues that are involved in the metaverse, and we're kind of not really involved directly, it changes. The description changes, what it can do changes. So it's, crypto, if the regulation of crypto is difficult, trying to get a grip on the metaverse and the challenges there is, well, I'm glad I'm not in Yas's position, put it that way.
Final word on the metaverse to you, Kylie.
Philip, I do financial services.
But there are financial services in the metaverse. HSBC is got a branch there.
I won't disagree with any of the challenges that have been highlighted, but I will also be incredibly candid when I say one of the joys about working at Copper is that we are an institutional infrastructure provider. We're all a bunch of people that like doing financial services, and we'll kind of wait and see what happens with the rest of some of this stuff. It doesn't mean I don't have my own views on it, but I delight in things more related to property rights, if I'm completely honest.
And if it's digital and you want to trade it, Kylie's your lady.
There it is.
Can I just ask, we're getting close to the end of our allotted time. There's a lot of this discussion, I would say to our audience, actually in the report. It's a very, very good read and covers an awful lot of the ground that we've talked about today in detail. If we're to get, and just focusing down on digital assets, if these are truly to make or to take us into this next generation of financial services, and the correct answer is not all of it. It's, should we be prioritizing the infrastructure? Should we be prioritizing the regulation? Or should we be prioritizing the law, or is it something else? Or what is it we really should be focusing on? And can I start with Stephen, please?
Innovation doesn't wait for regulation and lawyers. So whatever happens in the market will dictate in some respects what the lawyers and regulators then have to think about. So in that context, Philip, it's not really a matter of what one do you prioritize, it's more a matter of what do you need to do in order to manage the risks that perhaps the innovation brings, but equally how you manage that to realize the benefits of the innovation as well. So it's a bit of a long-winded answer, but I don't think it's an easy answer because you need it all basically. Which is not what you want to do.
I push back on that and say, actually, the regulators or their political masters do control the market because they set the rules. And if you look, for example, at Diem / Libra, the politicians decided they didn't want it, and they effectively blocked it by changing the rules at every turn. So,
but that shows in response to the innovation. The innovation will continue, and then it's more a matter of realizing the benefits, managing the risks, but you won't stop the innovation. So, the politicians, the regulators, etc. Ideally, they're ahead of the curve and they understand what the issues are as they're happening. Sometimes that's quite difficult for lots of different reasons, but ultimately they will have to respond to the innovation.
Right.
You can't stop it.
So you can't stop it, but you can maybe direct it into different channels. Carly, can.
Yeah, I mean, there are horses for courses, right? My brain will work differently to Stephen's brain will work differently to Jan's, to Oliver's. And we're very fortunate to have folks that are thinking about the law contemporaneous with folks who are grappling with the regulation. I'm going to disagree slightly with you, Stephen, that I I agree that the innovation will continue to happen. I don't think regulation has to wait and be responsive. I think we have so many examples from the traditional financial services world that we can see the risks, we can understand how markets operate, and we can put things in place to prevent it from happening. I would love to avoid 2008 in the crypto world. And we can, because we know what the problems were there.
We've
know
already had it, haven't we?
well,
The winter.
yet another area where I might, get controversial, but no, Philip, I just think that we don't have to wait to regulate in certain areas because, Jan, you mentioned the kind of that saying that folks love, the same risk, same regulation. And does that apply? Is that fit for purpose? Some of it is the same. Some of it really is. And in those areas, we absolutely can regulate without waiting. But exactly to your point, it doesn't fit for everything. And there are certain nuances that will need to be a little bit more tailored.
Okay, thank you.
And there are things, in fairness, Cara, that you can't reasonably foresee. I mean, the concept of crypto 5 years ago for regulators wasn't really something that was on the radar. AI, big data became very topical. If you wind the clock back 10 years ago, 15 years ago, nobody discussed cloud. So the innovation in the broad sense will continue, and then it's really a matter of how that's managed going forward.
Boris Pastor Oliver, can I just ask my team to send me the poll results, please? Because I can't get them on my screen. Oliver, can I just pass to you?
Yeah, I think it's going to sound a bit wishy-washy, but you get the best results when regulators and industry participants work together and actually create a framework to allow this sort of stuff to be done safely. And I think the initial hesitancy in the crypto world to engage with regulation and the view that's still persistent amongst some participants that the regulators are there to be feared and run away from is actually not particularly helpful, because it's industry participants, people really living this stuff day to day, that are best placed to assist the regulators and assist the legislators in coming up with a regime that both enables them to innovate, enables them to roll out products that people want, but to do so in a safe way. So it is a partnership. It works very well in the traditional finance markets that you have that kind of engagement. And I don't see any reason why that shouldn't be the case in crypto too.
Right, thank you. And final word then to Jan. You comfortable that you're getting the balance between fostering innovation on the one hand and looking after consumers and financial stability on the other?
We're trying, and I would say the experience we have now is also a bit, one needs maybe to distinguish about the pace of technological development, which is indeed very fast, and then also the pace of broad market adoption, which is sometimes not as fast, basically. And I think, of course, if you want to protect every single consumer, you need to be always at the very cutting edge of the technology. And one should strive there, but one needs to be realistic. That may not always be possible. If it is indeed about looking at the bulk of the market, I mean, cloud is been around for what, I guess 20 years. But I mean, really the mainstream adoption in our banking system is not 20 years old. I mean, so we've had a bit of time. I think the same thing on crypto and also the whole DLT market infrastructure ideas now. I mean, if we see, compare even where we were 2 years ago and now things are developing, but they are also not, I mean, the technological development or the market adoption development doesn't go linear either, basically. I mean, people are trying and then there's a dead end and then it's something else. And then, so in the end, I think, I mean, if you are reasonably fast, I think also the regulator can actually hold up, I would think.
Thank you. There is, for those interested, there is a chapter in the report on the technologies underlying all of this, including cloud and data storage, which is fascinating. I'm being shouted at my team to say we've come to our end of our allotted time. If you're interested in the polling data, it's on Slido, which will show you all the results. I would like to thank our panel, our team today, Jan Saessens, Oliver Lynch, Carly Lowry, and Stephen McWhirter for contributing so wonderfully to a vibrant discussion. Thank you all very, very much indeed. I think it's been most illuminating. Can I remind you the report is available on the website and on the attachments to this. as well as the tracker. And wherever you are in the world, thank you very much indeed for joining us today. We look forward to seeing you at a future Digital Monetary Institute roundtable. And with that, from London, we're signing off. Thank you and goodbye.
Thank you.
Thank you. Thank you all.